more or less like advanced variance part 2, all right? But let's recap. So what you saw in part 1, you saw that in discussing the advanced variance, we are doing 4 things, right? So we said 1, it is planning and operational. And the first video explains it a lot, planning and operational variance. So we dealt with that one. This one is even dealt with in the part 1 video, material mix and usage and yield variance. Material mix and usage variance. Mix and yield, sorry. Then we will be doing the sales mix and quantity variance. You can also call it volume variance. The last one is about the sales market share. Sales to market share and market size. And market size. All right. So the planning and operational has been dealt with. So now my focus is on this one, sales mix and material variance. Now, this one is coming from the material cost variance. How to find material cost. If you remember, everything we are doing comes from what we started before. So you know if you are preparing a reporting P&L or something, you start with sales. You remember. So you do sales, then less cost of sales. But you know, in man accounting, we are not trading. We are looking at it from a perspective of somebody producing. All right. So the cost of production is what we deduct. So the first thing here after the sales is material. So the direct expenses. So raw material is part of the direct. You need material, you need labor, you need some expenses to overheads to incur. So when we are looking at the material mix, and yield variance, like you've seen already, we are looking at material usage. You know, in basic, you saw that in the basic variance, when you are doing material cost variance, what do you need? You need the standard quantity multiplied by the standard price, right? You compare it with the actual. So the actual, this is the standard, the budgeted. You compare actual quantity by what? Actual price. That is what you do. Then you find the variance. All right. So with this, we learned that all I need to do in terms of knowing the quantity variance and the price variance of material, I need to change this one to what? AQ and maintain what? SP. So this one, this side. So you are coming to do something for me right now. Just a recap of something I want to see. This part will give you your material what? Usage, the volume that you use. Material usage variance. Material usage variance. And so the formula therefore will be what? Standard quantity minus actual quantity multiplied by standard price. Then if you want the formula for the price, it will also be, so we have material price variance. So that one too will be standard price minus actual price. So actual price by what? But remember, we said that standard quantity for actual production. So remember to flex this one to the actual production. And how do you flex? You use the standard quantity. If it was for one product, you do that quantity over one, multiply by the actual production to be able to get to that. All right, so this is what we do. And to make sure you remember this one, you are going to solve this question for me. Well, which page is that question set? Variance. Yeah, this is the basic variance. So material variance, this material cost variance. So you are coming to solve this question for me to see. Which one is that? Yeah, this illustration 3. All right, so everyone get to work. Get to work. So solve this one in the context of this formula that we have done. I want to see if you remember. So this is the question. Those don't want to show up the solution yet. Which one? All right. Okay, so do it now. Let me see. So you are solving this question. You are calculating the total material, the material total. You do the total. You are doing the price. You are doing the usage variance of product X, just to see if you can remember. All right. Don't forget, material cost variance is a combination of usage variance and what? Price variance. So if you can do the two, you add the two, then you can get your answer. So just in 3 minutes, do that one for me. All right. So what did you get for material usage? What did you get? 5,300 favorable. That's correct. 3,900 adverse. That's good. Online, what did you have? You didn't do it, Abby. That's good. Samantha, you didn't do it. You didn't do it. You too, you didn't do it. All right. So obviously, the formula is there. So material usage variance, the formula is SQ, AQ, what? SP. So we say you flex this thing for the actual production. So what is the standard quantity? The standard quantity, this is the standard cost card. The standard quantity is 40 square meters. So if you are flexing it with the actual production, it will be 40 over 1 because standard is 1. When you see standard cost, it's for 1. So you flex it by multiplying it with the actual production, which is 30,000 units. All right, that gives you 40,000. Then actual, what do you call it? Actual quantity is what? 39,000 square. Then you multiply it by standard price, which is 5.3, and you say you had 5,300 favorable. Why favorable? Because you wanted to use 40,000 quantity, but in the end, actually you used 39. So you have used less than what you should have used. All right. So that is that. Then when you come to the price variance, material price variance, is standard price minus actual price all over what? Actual quantity. You already know the actual quantity from here. So what is the standard price? You also know that standard price is 5.30. So what is the actual price? So the actual price, this was what you were giving. This is the actual cost of the thing you spent. And this is the actual quantity. So if you want the actual price, it is the 210,600 for the 39,000. What did you get for that? 5.4. All right. Actual quantity of what's the quantity? 39,000. So you had final answer 3,900. Interpretation of favorable or unfavorable. You wanted to buy something at 5.3. That was your standard, your budget. But at the end of the day, you bought it more than your budget. So that one becomes what? An adverse. These two, when you put them together, gives you the total material cost variance. So the total material cost variance, how much is that? 1,004. 1,004 what? Favorable. All right. So that is how we go about. This is just the basic. But we are interested in doing the material mix and yield. Now, the material mix and yield, you saw in the part 1 video that the material mix and yield come from usage variance. It doesn't come from price. It comes from here. It comes from here. So when we are doing advanced material mix and yield, this is how we derived our formula. And we are going to use that to solve a major question. So we said that material mix and yield is coming from the usage variance. We are trying to say, and if you listen to the example that I gave, it's like doing Gary soakings. No, Ghana, we do Gary soakings. If the Gary is more than the water, you will get a bar. That is what you get. But if the water is more than the Gary, then you get your Gary soaking. So the mix, how do you mix the two ingredients that you are using to come up with a more production, all right, efficient production, all right? So that is the point in this material mix and yield variance. So the same formula, we said from basic, it is SQ times SP, right? And the actual is AQ multiplied by AP. But like we said, we are not doing material mix and yield come from usage variance. So we will not be interested in prices, actual prices and actual quantity. So all we said was that, if you remember, we said you will change this one to AQ and still maintain what? The SP. All right, so that is that. Now, this is what we did. Now, we are saying that we are doing mixed variance. So all we need to do is to add SM to these quantities because it's from usage. So standard mix here, standard mix here. Then we will change this one to AQ AM actual mix by what? Standard price. So this is what we are doing. So from these formulas, like I said, we are not interested in price because we are doing usage, quantity of material we are using. So these two things is the things we will derive the next formulas from. So you saw it that material yield the yield variance will therefore be what? We will have SQSM minus AQSM all multiplied by standard price. Then the mix will also come from here. So material mix will also be AQSM minus AQAM all multiplied by what? SP. So this is the formula. So we are going to pick up a question and we are going to use this formula to actually deal with the question. So it is this same thing we develop in the table that you see here. So when you go to the advanced variance, let's go to math. Yeah, that is the standard mixing. So what percentage of Gary or what percentage of the water All right, that is the mix. That is it.
So which one is the standard?
The standard is what you set for yourself. Standard is budget. So you budgeted that. So let's say, so the question is, which one is the standard? You budgeted that you are using 50% of water and 50% of gari, and you will get something. That's your standard mix. All right, the SM. All right, that is that. But you, at the end of the day, when you were producing, take it like you you measured the water, or you were pouring water into the gari, but you had a standard that you are pouring 1 liter of water. But at the end of the day, probably when you were pouring, you poured more or you poured less. That is the real thing, that the actual mix that happened. And so that is what you are comparing it with. All right. So that is that. Now, your standard price, cost card price. All right. Your standard, the same standard price. So that is that. That is that. So the thing is favorable when more goods are produced from the same quantity of material. So if more comes out than you expected, then it means it is favorable. So if I mix the two ingredients that I'm using to produce something, and that thing gave me more quality product. Of course, please, the underlying thing is that it is quality, not shabby goods. All right. So if I mix the thing that I did, I had a standard, but at the end of the day, the one that I did came up more products, then that is favorable. But when it comes out less products, or I waste more material, then that one is unfavorable. All right, so that is that. Now, and in the video that you did this in the part 1 video, this is done. Yeah, so what I want to do is to take the material that I gave you, the safe soap question, and we are going to try our hands on that. So the safe soap company makes environmentally friendly soap using 3 basic ingredients. What is the name of the first ingredient? How do you pronounce it? Debbie and the Priscilla. Samantha, what is the name of this? How do you pronounce this? Lie. Okay. Oh. All right. Then we have coconut oil. That one there, every Ghanaian is familiar with coconut oil. We have shea butter. Now, the standard cost card is given. So that is the standard cost card for one batch. All right. And always know that standard cost is always for one. When we say standard cost, it is always for one. Now, you have the budget for production and sale in September being 120,000 batches. Actual production and sale were 136,000 batches. The actual ingredients were as follows. So if you take, according to Samantha Lai, 34,080, coconut oil 83,232, then shea butter 64,200. You are supposed to calculate the total material mix variance and the total material yield variance. All right. So you know your formulas. And I've shown you a template that you can be using. So this is like the one that we did in the first video. So the template is there. So this has been the template. So if you are doing, first of all, if you are doing material mix, total material mix variance, you need AQSM, and you can see it here, mix AQSM. you need AQAM. All right. Then the difference, which is here, you multiply it by the standard price. And this is the standard price. And that gives you your variance. Have you seen that? So you can decide not to use the table. If you take material A, you just use this equation to do it. All right. If you take material B, you just use the respective equation to also do it. All right. It's just that the SM, the standard mix, the standard mix is a proportion. So you have to do the standard mix. All right. So that is that. So that you can multiply the actual quantity by that mix. Is that okay? All right. So that is that. So can you try it before we all do it together? Try it. Try it. So everybody, this is the question. Try it. It's 8 marks. Let's do it together. So we know that we are doing first we are doing material mix variance, and we'll do material yield variance. Now, what is the formula for material mix variance? Yes, the material mix variance. What is the formula?
AQSM
AQSM. Okay.
minus AQAM times S.
Is that okay? So I said you can set your table up. The materials, according to Samantha, lie. Abi, we have coconut oil. Then we have shea butter. All right. Then we need AQSM. But you need to work your SM. You can decide to do it inside, or you can decide to do it somewhere here. All right, so that you know your AQSM. But what is AQ in the first place? It's for lie. Actual quantity. Actual quantity for lie. It's what? So it's actual AQSM. So yeah, that is it. So you know that the actual total quantity for of material for 136,000 baht is what you need. No, so you need the actual quantity, all of them. You need all of them. Is that okay? So the actual quantity, this is what you have. It's what? 34808 080. This one is what? 83 2. Then this one is 64 200. So these are the actual ingredients for 136. All right. Then you multiply it by the mix. So first of all, if you check the first video, what is the total of the actual quantity? You have to find the total of the actual quantity for 136,000. So it's what? You totaled it. It's 181,181,500. So that is this plus this plus this. You get one, you said it's 181,512. Then out of that 181,512, the proportionate mix that comes from there. So if you pick this one, lie, it will be 181,512 SM, the proportionate mix that came from them. The SM is what? If you want to do it somewhere, you can do it somewhere and bring it in. But it will be 0.25 over the total. What is the total? 1.35. That gives you your AKOSM. So continue. What do you think the coconut will be? You said it's 181,512 proportionate SM. That will be 0.6 over what? Is it? You said it's 135, 1.35, 1.35, 1.35. So that is what you are doing. This is AQSM. This one is what? 181,512 by 0.5 over this one. All right. So that is that. Yes, you can ask your question. And this is AQ, actual ingredients.
Yeah. So if they are why don't you use only the line actual by using the total?
Okay, so your question, so somebody is asking a question here in the face-to-face class that because we say AQSM, why didn't we pick, hold on, why didn't we pick this one and multiply it by the mix? If you pick that product alone, you are not mixing it with anything. Mm-hmm. But mathematically, when you can, it comes up to you giving you your same. So this is what I want you to do. You want to do this of this, this of this, this of this, and total. That's what you want to do. Yeah, so do it. Somebody should also get us the answer, the total answer for this side. So we know that at the end of the day, the whole total for AQSM is equal to 181 because this is what is being shared. 181 512. So what we are saying is that the actual quantity of the product that was there, materials that was there, we are determining a standard mix, a budgeted mix, of how we would have used the product. So if you want to do this of this, this of this, and total, So I want you to finish to your point, then I will explain to you why we are doing it this way and how you are doing it this way. So we are saying that the total quantity, we are taking some mixes of it. We are taking some mixes of it. So, but you go ahead and do it. I want to, guys, do you understand his question? Those online, do you understand his question? So he says that because we said AQSM, but I think then that means that you've not done the video on the first one, right? Yeah, you didn't finish it. Yeah, it's clear. So he's saying that because we say AQSM, but remember, we are doing total material mix. So because he said AQSM, he sees this one. Okay, so this is the actual quantity. It is here. So if I take lie, its AQ is this one. Then its SM is the standard mix here. But I want him to do it because that is a pure issue of mathematics. So do that. Do that. So you online too, you can also do same.
S 33
No.
3361.
Why you did the thing he was talking about?
No,
So which one are you giving me?
the one you have on the board.
Okay, so this one.
Yes.
Okay. So what are your answers? So this is
3361 613.33.
33.33. All right.
Then the second one, 80672.
80672.
Yes.
The
Then the
last
share butter,
it should be something
67 67,226.67.
0.67. So when you add everything, you will know the total quantity of material that has been used. It should be equal to this one. And did you do what you were doing?
Yeah.
You had what? Oh, then it means you even didn't do it well. You said 67. No, I don't think. Yeah, no. Because if you this one alone, if you did this one on this one, it is half of that. 60% of this, and 60% of this is also big, and 0.25 of this is also bigger than what you are. So when you add, it should be around 90 something. I mean, you are doing this multiplied by this.
So that if you take like 30 multiply by the standard.
And that's what I'm saying. Your answer is wrong. Even if you do that, the answer you are giving me is wrong. Because now the reason why you don't need to even do that is simple. We are saying that, so for example, we are producing gari, all right, gari soakings. We said that we need 2 liters of gari, all right, and we proportionately mix the gari with the 2 liters of water with. How do you even measure the gari here? Is it kilogram? Let's say 0.25 kilogram of gari, and we want to get gari soakings. All right. So we are saying that, can we, of course, you learned it in the initial stage that the material should be interchangeable. If the materials are not interchangeable, then it means we can't even do the mix. So we are saying that, assuming this is material 1, material 2, we have another thing like that, another thing like that. We will determine the standard mix using the total of the standard, and we do proration. So if you pick one material, you divide it by the total, like the way you picked. I think your 1.35, you realize that you added here, and you pick. but we are doing it on the actual quantity of the materials. Now, the actual quantity of the materials, these actual ingredients, we are not going to be seeing them individually anymore because we are combining to do a proportion of them. It's like the way we do capital allowance in tax. We don't see the asset immediately, it is in the pool again as it is. So what we are doing is that we want to get proportionate of that total. We want to mix the thing. So in that case, if you say we should do it on this one, it means you have already proportionately taken that one already. You are not determining a different proportion, like, let's say, let me increase water and decrease Gary. No, if you do it like that, that is not what you are doing. But that in material mix, what we are saying is that, okay, if I reduce lye and I increase coconut, how will it be? So in that case, I cannot be focusing on this one. I am already limiting myself that I am taking 0.25 of this, I am taking this of this, and I'm taking this of this. It is fixed already. But we want to change the proportions to see how many products we can come out with, or what is the variance. That is basically what we are doing. So you add them up, you determine the standard mix. So, all right. So probably, maybe you want us to add T to this place, total actual quantity, so that maybe you will know that you have to total this, something like that. But I mean, the terminology signifies it already, and the explanation that you have for that. All right. So that is that. So now you've given me AQSM. What is the next thing? AQAM. AQAM. Actual mix. Actual mix. I think that one is done for you already. True or false? The actual mix is done for you already. Because you are going to take this. This is the actual mix of this figure. It has already been done for you already. So this is it. This is the actual mix. So if we take the total of 181,512, the actual mix of this has been given to you already. So it means that this one is already 34,080. Actual quantity, actual mix. Actual quantity, actual mix. This is the actual quantity. The total actual quantity is 181. What is the mix of that? What is the proportion to each of the products? It is done already for you. So this total product, if you add this, you gave me 181,512. What is the mix of that in respective to each of the product? The actual mix. This is the actual mix. So out of the total, we have 3408 for lye. We have this for that. We have that for that. So that is the actual mix. All right. So that is that. So somebody will say, okay, sir, then why not we do? You see that you get the same answer. But that's why I don't want you to waste time. You can do 34A0,080 over 181,512 multiplied by 181,512. You will come back to the same place. Come back to the same place. All right. Because the AM, if you remember the SM, you did this plus this plus this, then you had the total. So when you pick this, you divided it by it, and you were multiplying it with the actual quantity. So you multiplied it with this total. And that is what you have done, this over this and this. But here, when you do it, it will become 34A0 over the total multiplied by the total, and it will cancel out itself. So that thing has been done for you. All right. So this one too is straightforward. That will be 83,232, 64,200. So what is the difference? So this part of the formula is done. So you know what? The difference is what you will do here. Then you will just bring in your SP. Then you get the variances. All right. So that is that. So what are the differences? As for the SP, is the standard price. So look at the question and call them out for me. What is the SP? It's 10, right? 1043. All right. So get the differences and let's multiply it and go. If you set this thing up well, you will get to know whether the thing is favorable or adverse from the difference. You will get to know. So whichever one you have, you can give me. The difference, this versus this. The last one, 3026.67. Then once you get it on the same calculator, you just multiply it by 3, then you go. The variance is what? 9080.
0.01.
0.01. Okay.
Oh, my
All right.
battery is so good. So the second one,
The second one.
negative 2,560.
So do the multiplication and get us the value. 10,240.
Yes. Then the first one,
So this is
negative 466.67.
the variance is what? But what is the value here first? You said negative what?
Negative 466.67.
So by 10 will be 4666.7.
7.
So already from here, you know that this is adverse, this is adverse, this is adverse. So the final answer will be what? Ten to 40. That's what you are. $5,826
0.69.
adverse, eh? All right. So that is that adverse. This is how you go. But we have material yield to do. What is the formula for material yield? Standard quantity, standard mix, minus
actual quantity.
actual
Standard
quantity,
mix.
standard mix.
Multiply by this.
So set your table. So we have the materials, lye, coconut oil, shea butter. So we need SQ SM. SQ SM. You already know your SM. So what will it be? So here you have to be a little careful with it. Because remember, and that is something we've been saying. We've been saying that thing. When it comes to SQ, what did we say? Flex the SQ with what? Actual production. If you forget that thing in variance, you are dead. Standard quantity is always for actual production. That's why we did flexible budget. Standard quantity is always flexed with actual production. That is it. Take note of that. Standard hours is also flexed with actual production. So in material variances, standard quantity flexed for actual production. In labor variance, standard hours flexed for actual production. So take note of that. So what would our standard quantity be? Because we know that this one, you are having, what do we call it? The standard quantity to flex with actual production. How much is that? Because this is it. This figure that you see is for how many products? One. So if actual production, what was the actual production? 120,000. Good. So you see, be careful. Actual production, flex with actual production. This is the budget production. It's 136,000, not 120. This is actual production and sales. So if you want to flex your actual quantity, what it's going to be is that you are going to take 0.25 over 1, multiply by 136,000. That part is giving you the standard quantity. That is that. All right. That is that. So that flexing thing you are doing is what we are interested in. So this side will be like 0.25 multiplying 136,000. All right. So that is that. That's 34,000. All right. That's 34,000. So this, you said this is 34, and you said coconut is how much? So now you know what to do. So 81,600, and this one is what? 68,000. All right. So for some of you wondering how we got this, that one will be 0.60 multiplied by 136,000. This one will be 0.5 multiplied by 136,000. But AQSM is not something you need to work for. You already have it. You did it when you were solving this one. AQSM. Have you seen that? So you just do copy and paste. This one is 33,613.33. This one was 80,672. Then the last one was 67,226.67. The difference is what? All right. SP doesn't change. 10, 4, 3. So the thing is simple. We say standard quantity, standard mix. This is the mix. This is the mix. These are the mix. The standard quantity was 1. So this is the mix for one quantity. 1. This is the mix for one batch. Have you seen that? The mix for one batch. So we want the mix for one batch, flex for actual production. So mix for this, flex for actual production of this. That is why we did it. So don't confuse yourself and say, okay, if this is the standard quantity, what is our standard quantity? The standard quantity is actually one batch. Because the question told you the standard cost card for one batch, that's the quantity. The price for one is this. So standard quantity is 1. Then don't confuse and say, what is the standard mix? This is the standard mix. That is the mix for 1. But we want the mix flexed with actual production. So the mix for 1, flex for actual production. So when we started, I've always been telling you that anytime you have SQ must be flexed with actual production. SQ, anywhere you see SQ. All right. So that is the SQ for the actual production, right? So that is why we did it. We just go straight away like this. All right. So if you hide the difference, then you can get it to me. Then we'll move.
So the first one,
Mm-hmm.
386.67.
So that one mean here will be 3866.7, right?
Yeah. The
Next.
second one,
Mm-hmm.
928.
928. One multiply. Yes, ask your question.
Why is it that they are not dividing it?
You give me the figures. I'll come back to any question. Yes. That was what I was just explaining to you whilst you were writing. All right. So it's what? 3712.
Yeah.
Favorable, right?
The third, yes,
Third one,
773.33.
191.
2319.99.
Okay. 99. All right. Also favorable. So the total is what? $9898.69. So let me address his question. So, like I was saying, me, I knew that that will be in your head. So somebody says that. So say, why don't we do the standard mix was, why is it not 0.25 over 1.35? All right. So that is his question. Now, just as it happened under AQAM, the same thing is going to happen. This total that you see is the total for one production. One production. The total for one production. Remember, the thing is simple. When you were doing AQAM, you saw what happened. AQAM. You are picking, so your AM, the total of your AM. So let me go back to that. It's the same thing that happens here. So you remember that the AQ, the actual quantity, and please don't forget, it is the totals we are looking at. So you saw this AQ here. You saw it there. And we told you that you are multiplying this by what? The total. This AQ is also its total. So if you want the AM, mix of the AM, what are you going to do? You are going to pick this one, right, over the total. That is the AM. And you are multiplying it by what? The AQ. What is the AQ? This same figure. Have you seen that? So that's why your first question, I said probably we need to add T here so that you know that the thing is the total actual quantity. So the AM is the total of that thing. Sorry, the AQ is the total of that thing. In similar regard, the SQ, what do you think it is? It is the total for the standard. And what is the total for the standard? So probably you want me to put TSQ there. The total of the standard is what? 0 is 1 point what? 1.35. So if you do your SM, which is 0.25, over your 1.35, you are multiplying it by what? 1.35. So it cancels off itself. But remember, we are flexing it to what? Actual production. And so therefore, you are multiplying it by 136,000. Have you seen that? So not to waste those kind of time is the reason why you know that that is the end game. So you won't even bother doing this over this, multiply by this, by multiplying by this. All right. So that is it. All right. It's a good question you ask. Sometimes this thing clarifies the observer's mind. All right. So basically, that is that. All right. All right. So that is how we go about this. All right. So that means that if I give you any extra question that is demanding your ability to calculate material mix and stuff, you should be able to do it. It is a full exam question. All right. So that is that. The next one we are going to do is this one. Sales mix and quantity variance. Sales mix and quantity variance. Sales mix. And quantity variance. But do you remember basic variance for sales? Because that is where the foundation is coming from. You have to remember that. What was the formula for basic variance sales? You said the standard basic. Sale is what?
The sales quantity variance. The standard quantity.
Standard quantity. No, I just want the. So you said standard quantity minus actual quantity. All right, you let me hear you.
And the selling price for marginal is the sales minus variable. And for
all right, so let me help you. That's a very good observation that you have done. So you said for marginal, it was, So we call this one, so when we talk about sales variance, we were looking at kind of the profitability that comes from the, how much profit we get, all right, in terms of we selling something, all right? So the standard we wanted to sell to get money. And the focus is not on the sales per se, but it was on the margin, sales margin. Because when we say selling price is cost plus margin. Remember, because in any costing system, we know that selling price is equal to your total cost plus your profit margin, the what you put on top. That makes your selling price. So when we are looking at sales variance, yes, you went straight to give me the formula, and it is true. So we said that it is standard quantity minus actual quantity, but I want you to call this one standard margin. You know, you called it SP, but you defined your SP, and you said that if the SP we are using marginal costing, the standard margin will be what? Sales minus what? It's not contribution, minus variable cost. But if we are using absorption costing, what will it be? Selling price minus what? It's not contribution. Absorption costing, who remembers? It's total cost. Total, let's not even call it total cost. We call it, let's take it like that. Total production cost. That's what I want you to say. And total production cost is derived by you doing variable cost and absorbing the fixed cost inside the thing. All right. So that is the difference. You know, this one gives you contribution. Good. This one gives you contribution, and this one gives you what? Profit. So if you have thrown away your marginal and absorption costing, that one too will bite you. So this is what we learned under the sales variance. All right. So, you know, in the sales variance, we have when you pick total sales, and that is the diagram you see here. When you pick total sales, is the price versus the volume. It is the volume, the quantity is always where the mixes come from. So the sales volume is here. So the sales volume, we are going to do sales mix variance and sales what? Quantity variance. The same thing. So we learned that selling price and volume variances are fundamental concepts. We did that in the basic. That's what we did. So we did sales price variance, which is the price variance. You realize that you need the standard price, which is the budgeted price, minus the actual price. All right. Then you multiply it by what? Actual quantity. Actual quantity. So this is what happened. So actually, if you remember clearly, when we were doing basic variance, we did the same thing. We said standard quantity, standard price, but we said the standard price, be careful. So it's supposed to actually be SM, all right, depending on, so that you know it is. So if it is SP, like it's profit, not selling price, all right. Then we did AQ, actual quantity by actual price. All right. By actual price. Then we could turn this one to what? Actual quantity and still maintain the standard margin. All right. So we said that between this one and this one, and between this one and this one, gives us something. All right. So here is SP, AP, what? AQ. All right. And here is what? SQ, AQ, SQ minus AQ, SP. But this SP has its own meaning. All right. So that is what we learned today. All right. So basically that is that. Now we are looking at sales mix variance. So if we have variety of products that are interchangeable, So, for example, if you are a business owner, you sell Ideal milk. All right. And you also sell Kaneshi. Please, how do you spell the Kaneshi? Carna. Hey, is not Kaneshi like a place? Eh, it's carnation. Oh, okay. So, all right, carnation. What other milk do you know? What? Nunu milk. Nunu, eh? And you said there's popular milk. Hey, me, I've not heard of anything popular. Debbie, which one is popular? Remember, this month is something awareness month. Too. This one you are talking about popular milk and this milk and that milk.
Wait,
This one you are talking milk. This is something awareness month. Too. All right. So if you have this product that you produce to sell and they are interchangeable, what mix do you sell to make the highest revenue? Should you sell 2 of Ideal, 5 of Carnation, or what mix should you do? So if you are somebody who sell at the shop and you realize that people buy more Ideal milk, then it means you have to mix it well so that I don't come. And in Ghana it's funny. You can go to a shop, you are saying you are buying Ideal milk. The person will tell you that, oh, I didn't make there, I don't have some. But Carnation is good though. Take Carnation. Meanwhile, when I was leaving my house to come, I was coming to buy Ideal milk. So I went to buy a shoe. I ordered a shoe from Cantamanto. I told the guy I wear size 40. The guy brought me size 41. And I said, chairman, I can't take this size 41 that you brought. But I told you that specifically that I wanted size. He said, oh, don't worry. Size 40, okay. Size 40 is the best. I'm like, so you are trying to tell me I don't know my size. Yeah, so that is what we do here. So which one should we make? So that is what you see here. Sales mix measures the impact on profit, all right, due to the changes of proportion of the product sold as compared to your mix, the budgeted mix that you did, all right. So if you have different combination of products that you have planned, it demonstrates the deviation if the actual mix was different from what you actually budgeted to do. So that is what we are trying to look at here. So the formula is the same thing. So if we want to derive the formulas, but remember, when it comes to I've told you that the SP is actually margin. All right, it's actually a margin. So we said that you needed standard quantity and what? Standard margin, like kind of standard price. All right, so and we did actual quantity. All right, so like you can also say what is our actual profit margin. All right, so what we are going to do is that we flip this one, we call it the actual quantity, and we still maintain this oga here, right? That is what we did. So here, all that we are doing is to add the SM to the thing because of the mix. So here will be SQSM. But please, the SM is not this SM. This SM is sales mix. So probably I should change to my P, but you should understand what the P is. We know that is margin, all right? The standard margin. Take note of that. So I should use the P for you. I should use the P. so that you don't get confused. But you should know what that P stands for. Is that okay? So you can say profit or something, but I mean, just be careful. Oh, just be careful. So all that we are doing is to add SM to this. All right. Then here too, we will change to AQ what? AM. Still maintaining the SP. All right. So that is that. So from like we told you, this thing we are doing has nothing to do with the price. It has nothing to do with the price. So we don't need this one. We don't need here. So our focus will be the top there, like the way we did in the usage. All right. Because we are not doing mixes for pricing. All right. So we have two formulas to develop here. So that is what you see here. So the difference between SQ, SM, SQ, SS, sorry, SM, supposed to be SM, SQ, SM. Because all we did was to add SM to it. The difference between SM and AQAM are the standard. So this is what you do. All right. So we have here SQSM, AQSM, SP. But please, me, I've told you that you have to be very, very careful with the SP. All right. So that is that. So take note of that. Now, that part that you are doing, which one would you think will be that? So I want you to, is it for sales mix or sales quantity? This one that you have done now. It's what?
Sales mix.
How did you know it was sales mix? The mix of, because everything is there. It is looking at the standard mix, right?
Yes.
The difference between the standard mix. All right. Then this one will be what? AQ SM minus what? AQ AM also by SP. But please, the SP, time and time again, I'll remind you, the SP is standard margin. All right. So I can use SM to call it standard margin, and this one, SM, standard mix. All right. So that is that. So take note of that. So that is what you have there. That is what you have. So we will need to solve a question. Everywhere you see standard quantity, it has to be flexed. All right. So we said this side is for what? Sales what? quantity, right? And this side is for the sales mix. So all you need to do, now that you've been able to develop your formula, all you need to do is to solve a question. So can you try illustration 23? Illustration 23. Oh, you didn't bring your books. Oh, let him pay 298. So the requirement is that we are doing sales price variance, sales volume profit variance, sales mix profit variance, sales quantity profit variance. So the question helps you by introducing the profit so that you know a standard margin, the margin, all right? So sales price variance is a basic variance. Sales volume variance is also a basic variance, but these two are advanced variances, all right? So let me see if you remember what you've learned so far. So actually, the comparison is between Q and Q. You know, this one and this one is the same. So this one is actually the quantity variance, sales quantity variance, okay? Because the comparison is between, as for the SM and the SM, they are constant. But the SQ and the AQ is where the variation is. So this one becomes quantity variance. Then this one, the AQ and the AQ is constant. The SM and the AM is where the variation is. So it's supposed to be the mix variance. All right. Please, do you get it? Do you get it? Do you get the point I'm trying to make? This is sales quantity variance because the variation is between standard and actual quantity. Here, the variation is between SM and AM. So that one becomes the sales mix. Is that okay? Just as we did in the first one. Just as we did in the first one. So this is it. No, where is that? The first one that we developed. Have you seen that? So the mix, it was between the mix and mix. As for AQ and AQ is constant. Here is quantity, which is the yield, volume. So this one and this one. All right. So that is that. So Christian, your observation, you see it, right? That's how it is.
Okay.
All right. So in a few minutes, try and finish this one, and let's go. All right. So KZ operates an absorption costing system and sells three products: A, B, and C, which are substitute to each other. Like I said, they are always interchangeable. Substitute. The following standard selling price and cost relate to these products. Remember, the following standard selling price and what? Cost. Budgeted fixed production overhead for the last period was 81,000. So that is the fixed overhead. Budgeted overhead over budgeted level of activity. So you have already seen your budgeted overhead, budgeted total fixed overhead. This was absorbed on machine hours. So the level of activity is what? Machine hours. So if you remember your lecture in absorption costing, you know that overhead absorption rate is equal to total budgeted overhead. Total budgeted overhead over total level of activity. All right. The level of activity is in this question is machine hours. All right. Level of activity. And in this question, you know that it is machine hours. The standard machine hour for each product and the budgeted level of production and sales for each product for the last period is also as follows. So if you remember, this is the standard. This is the budgeted. So your level of activity, so it will be like this. OAR, and please remember, it is always the total level of activity. OAR is equal to 81,000, which is the budgeted, total budgeted overhead. Total level of activity, you need 0.3 hours for how many units? 1. And per your budget, you are doing how many? 10,000, right? So it will be A will be 0.3 of, if it was for 1 and you are doing 10,000 units, this one will be 10,000. Plus the next one, 0.6, 13,000 plus 0.8, 9,000, so that you can get the total level of what? Activity. We did this thing in absorption cost. So what will be your overhead absorption rate? Quick, what will be your overhead absorption rate? Now, if you have your overhead absorption rate, that's what you are going to use to absorb in your cost structure to determine the profit, because this one, they use absorption costing. So your SM, which was your SP, should be absorption profit, all right? So you will start, A is 4.5. 4.5. So 4.5 CDs. This is CDs per what? Machine R. So you do A, B, and C, right? So what is the selling price for A? What is the selling price for A? Actual selling price is given, so you shouldn't waste time. 14.50. B, 15.50. But what are the budgeted ones? Because we actually use the budget one to determine the, this ones you are giving me is actual. Right? Is the actual. I want the budgeted one. Because we say standard margin. So we are not using actual margin.
Standard price. Standard selling price.
Mm-hmm.
The overhead absorption rate.
Standard selling price, selling price. Oh, but it's there now. You should be able to see these things. That thing there, you are supposed to see it.
Okay. So it's 81,000 divided by 10,000. That's 8.1 for
It's what?
8.1 for A.
How did you get the selling price?
The budgeted production.
I think the question didn't show it. This is where it's supposed to be. The following standard price and cost data relates to the 3 products. So it didn't come. It didn't come. Wow. All right. So what's KZ, right? Okay, let me see if I can get it for you. Use this. So it's supposed to be here. So use this. Let's assume that the selling price for A is 14, right? B is 15, and C is 18. Is that okay? So this is the standard selling price, all right? Then let's assume the cost to be the total cost. Now let's assume materials for A B, and C. What do you have there? Yeah, what do you have there? For material, A, B, and C. In the book, the solution part. How much is for material? How much is for... All right, you just give me a second. Let me check. Is that okay? Same question. 81,000, right? And these are the same things. All right. So these are the standard for the three products. These are the information there. So we did 81,000 and we used this one for overhead. Is that okay? So what will be the selling price, standard selling price for A? So instead of ABRK, we have ABC. So for A, standard selling price is what? 14, right? 14, B 15, and C what? 18. Then you less cost of production. So we have direct material and direct labor. But don't forget, we will absorb overheads based on machine hours as part, all right? Because this is absorption question. So DM, direct material per unit, how much is that? Direct material is how much? This is the standard. They will need three. Which one? 1.80. Which price are you talking about? You will need 3 kg. You can't see it well. So this is it. You will need 3 kg at 1.80. That is the price. You need 1.25 at 3.28. So do the multiplication and let's see. For A, 3 kg you need. And the price of a kg is 1.8. It's what? 5.4. Next one, 1.25. So let me mention it to you. 1.25 at 3.28. 4.1. Then the next one is 1.94 at 2.5. So what will you get? 4.85. So that is for material. Is that okay? Then you come to labor, direct labor. You need 0.5 hours. Every hour is 6.5, all right? So, 3.25. 5.2. 4.55. This would have been it if we were doing marginal variables. But we need to add overheads, fixed overheads that we absorb. So the overhead is 4.5 per machine hour. How many machine hours do you need for product A? It's 0.3, right? So what will it be? That's 1.35. So you just doing 4.5 multiplied by this, 4.5 multiplied by this, 4.5 multiplied by this. We are absorbing the overheads into it. So this is 1.35. Don't forget, we are subtracting it from the selling price to get our profit. 2.7. 0.45 by 8. 3.6. So when you subtract, what will be your margin or your profit? So that is your SP, that SP that we are talking about. So you've gotten your SP. B is 3. A is 4. C is what? 5. All right. So that is the SP, the standard profit. Because it's absorption, we call it standard profit. So now you've seen the standard profit from what you needed. So in the formula, you've been able to find the P, this one, and this one. The next is what you need to do, SQSM. You need to do SQSM, AQSM. All right. So that is that. So if we are doing, for example, if we are doing, which one should we do first? The mix. Yeah, what's the problem? Well, what's the question? Sales, that is basic. So sales price variance, what is the formula? Standard price minus actual price times actual quantity. So what do you get for the basic variance? We have 3 products. So A. So what will be for A? Or you can decide to do it tabular form ABC like this, or you can also decide to do it ABC like this, whichever one that you are doing. So if we take product A, what is the standard price for product A? 4. What is the actual price? 14.5. What is the actual quantity? Actual quantity, 9,500. What do you have? But this one, you said, let me see. It's 14. Why 4? Standard price. The SP is SP. Please, you see, you are confused now. The SP, I told you that SP is what? No. Standard margin or profit.
Yes.
And so be careful. Be careful. All right, so that you don't confuse yourself. So B will be also 15 and 15.5. 13,500, right? Then C 18, 19, 8,500. So you get your answers, then you go. Well, that is the A part of the question. So we are calculating the A standard sales price. All right. So you can get the answers and you sort it there. Then we have sales volume profit variance. You see, the examiner or the question made it simple. We could have said sales quantity variance or sales volume variance, but he helped you by bringing in the word profit. So you know that when you do standard quantity minus actual quantity, the figure that you are putting here is SP. That SP is not standard price, it's profit margin. That's why he has introduced the word profit for you, so that it becomes easier for you. Is that okay? So are you done with this one? What is, give me the figures. 4750. Is it favorable or adverse? Favorable. Because this is selling. You budgeted to sell it at 14. You were able to sell it at 14.5. Into more. All right. Yeah. 6750. Favorable. 8,500 favorable. All right, so that's fine. All right. So come, which part don't you understand? The C. You have a problem with the C. Is it the 18 or the 19 or which part?
The 18. Like,
This is the 18. This is the 18. And this is the 19. The actual. Well, what's the problem?
negative answers.
So which part don't you understand? Is it so the term of the thing is sales price variance. Price. This is what you budgeted to sell the thing. Sales price 14. But at the end of the day, you were able to sell it at a price of 14.5. So it is to your advantage. That is why it is favorable. So is it because of the negative? So sometimes you have to bring the variance home, like to normal level, so that you can interpret it well. All right. So the volume variance, this is how we go about it. All right. So what was the standard quantity? But don't forget, we are here again. Standard quantity for what? For what? Actual production. You have to flex it. We are here again. So always flex it with the actual production. We are here again. So the standard quantity, what was the standard quantity? 10,000, right? Standard quantity, 10,000. So this 10,000 is for how many products? What were they doing? The standard machine hours for this, they say standard machine hours for everything is as follows. So here you are. So this is it. So what is your SQ? What is your AQ? Actual quantity. How many did they sell? Sales is 9,500, right? But what is the standard? So how do you do it? Mm-hmm.
The budgeted production of those
This is the same thing you are saying. There's nothing different.
30,000.
And those are the, so this one is what, 10,000. So you see, so this is the full complete question. So if you don't have the 10,000 too, you have it. The only thing that didn't appear in your book was this part. Is there? So what is your SP for first product A? That was 4, right? All right.
But we can't flex it.
How do you do flex? It's not just about saying it. You just have to understand what you are doing. How is the statement? So mathematics. That is still English. There is something in front of you. What is what and what is what?
10,000 multiplied by
Where did you get the 1 from? Did they tell you that the standard quantity for one product, did they give it to you in the question? No, so you see, you need to understand the things you do so that it's not like, oh, you just say it, then no. We said that when you are given a standard quantity, which is normally one, when we say standard cost card is for one, right? So if you are giving for one, we say it is standard quantity for actual production. All right. So that is what you do, standard quantity for actual production, so that you can, if they gave you for one, it will be sad or it will be unfair to compare a quantity that is for one production to an actual, which was for about many, and say the person didn't do well or did well. It will be very sad. Yeah. So when you face the question, so for example, this question, they gave you, this is a standard machine hours. Have you seen they've added per unit? But they gave you budgeted production and sales. What? It is not per unit. It is already in what? Full units. Total already. Total. So if for anything, they budgeted to produce 10,000 units. In actual sense, they produced 9,500 units. That's what they are telling you. So it is not for one that you are saying, if 10,000 is for 1 unit, then you do 10,000 over 1 unit multiplied by. No, this one, they've already given you the total. So you have to be, you have to shine your eye to see the differences. All right. All right. Is the English? Me, I know. Yeah, I know. So you can somebody can say this 10,000 unit is for the actual production. So you do 10,000 over 9,500 multiplied by 9,500. That is you flexing it. Then that will still bring you back to 10,000. All right. So standard quantity for actual production. Have you seen that? 10,000 over 9,500 multiplied by 9,500. All right. Because I remember when I was teaching you flex, I tell you that pick the activity divided by the total, the budgeted. But you can actually get it too. You can get it. It still gets you the same place. But it's just that if you are doing the total, you must do for the total. If you are doing for one, you must also do for one. Then you flex with the actual production. All right. So how many units were there? So we said pick the level of activity. So if it is this one like this, you are going to do 0.3 on this one. And I think we did it somewhere here when we're doing the, have you seen this one? So that is that. So this one, it's actually for 10,000 units for the production that they were doing. So it's 10,000 over 9,500 multiplied by 9,500. It ends it. All right. So do it for all of them. Which formula? No, this is basic variance. So this is not mix. We are not the. These are the mixes and the quantity. Don't confuse it. These ones are simple. Hey, so now you have learned the the big ones. So wow, that's interesting. All right. So 13,000 versus 13,500. What was this one? 3, by 3. Then 9,000 by 8,500 by 5. Yeah, so that is the basic one. So do that one quickly, then let's go. But of course, the reason why we are here is because of the advances. So your SQSM, let's go. Let's do the sales mix. As for these ones, you should be able to do it. I mean, this one. The online squad, are you there? So
Yes, sir.
we have A. So what is the formula for the sales mix? The mix was the one down. Don't forget. So it was what? AQ SM and AQ what? AM. All right. So you have your material. You have AQ SM, AQ AM. You get your difference, then you multiply it by your standard margin. And the standard margin, we found it. That was 4, 3, and 5, right? So we have, in this case, we have B, R, and K. B, R, and K. All right. So what is AQ? And don't forget, you remember we were discussing things of TAQ, total. So what is AQ? Actual quantity. These are the quantities. Actual quantities. So what is the total of that actual quantity? So before you even start, you know that the actual quantity is how much? Total 9,500, 31,500. So that is that. So AQASM, you know SM, standard mix. What is the standard mix? Which one do you think is the standard mix? This is your standard mix. Standard budgeted mix. So you are going to do like the same thing we did before. 31,500, right? And your mix, be careful. Because the mix, how do you go about it? Yes. So what is the mix? The standard mix.
For A, 10,000 over
How much do you have?
50,000.
10,000 over, but you can, it's a mix. So mix, reduce it to the barest ratio. So instead of writing the full thing, you can write 10 over 32. All right. It's a mix. So this one will be 31,500. But if you want to add the 00, you can, but it's just that you are wasting your time. It's a mix. It's a proportion. So this one will be what, 13 over 32. Then this one too will be 9 over 32. So get us there. But as for AQAM, do you need to struggle to do it? AQAM. It's copy and paste, right? 9,500. This one was 435. The margin we did, the profit. So the first one I have 9843.75. All right. Then this one too is 31,500 by 13 over 32. That gives 12,796.88. It's 875, but I've made it 88. Then this is 9 out of 32 by 31,500. 8859.38 down to two decimal places. So this one, if you strike the difference on this one, I think you're having, is it 343.75, right? All right, then multiply it by the four straight away to get the variance. It's what, 1375. Is there a point? It's straight. All right, so that is adverse. Can you explain to me why that is an adverse? Uh-huh.
The standard
Mm-hmm.
was higher than the actual.
That is what happened. Clearly, standard mix was higher than actual mix. The next one, the last one, I'm having 359.38 by 5. That gives me 1796, correct? 88. Also, it's not favorable. This one is, you said this one was how much? You said 906 here, 0.25. So that's 12,796.88 minus 13,500. It's 703 rather. 703.12. That's what I'm having here. So by 3 is 2109.36. And that is a favorable. Remember, this is not a cost variance, so this is a revenue variance. It's not like the other one we did, that was material mix. That one is a cost variance. This is revenue variance, all right? So the other one, this one you are saying adverse would have been favorable because that one is a cost variance, all right? So take note of that. All right. So what about the last one? Sales quantity. Sales quantity. What's the formula? SQSM minus AQSM standard profits. All right. So the same thing. Set up your material. We have BRK. But you know, one of them has been done for you already. So it shouldn't be a problem. Which one is that? AQSM. So copy it and paste. First one is, so this is SQSM AQSM. You have here 9843.75, 12796.88, 8859.38. All right, that's fine. So the problem becomes the SQSM. But that one too is easy now, right? Because it is actually your 10, 13, and what? 9. Because if you are supposed to, if you do the proportionate thing, you will come back to the same thing. So straightforward, you can do that. So 10,000, 13,000, and 9,000. So strike the differences. Here will still, the SP or the SM will still be 435. 156 point, and this is a sales variance, so it will be an adverse.
No. That's
The difference is an adverse now. When you multiply, it's still adverse. So multiply it by 4. When you multiply, it's what? 625 point, or there's no point. So adverse. The next one. $203.12, 609.336. But always total it when you are done, okay? $140.62 multiplied by 5, 703.10. All right, adverse. So when you total, so that is how we do the. All right. So can we wrap up with the last one? We are tired, right? All right. So we will continue later. All right.